Hello class. This is a short week, I think because of the Labor Day holiday, so I thought I would make a video for chapter number 2 where we're going to record transactions using something called debits and credits or double entry accounting, and we'll see some records, documents called ledgers, journals, and trial balance. But before we take a look at those items, let's review how we recorded transactions back in chapter number 1. So we started off with our accounting equation. Assets are equal to liabilities plus the stockholders' equity. Here's all the things the company owns, equal to what the company owes to creditors, to lenders, and the leftover amount to the equity owners, our stockholders. And the way we recorded transactions was to put down accounts. Remember these different classifications of our accounting records under each of these three different types. So of course the first account we had for assets was cash, and then the next best thing to cash was the right to receive the money from customers called accounts receivables, and we had some other assets. Under liabilities, the only account we saw, I believe, in chapter 1 was called accounts payable, the amount we owe probably vendors when we buy stuff from them. And then under the equity, we had the common stock account that represents what the owner put in when they invested in the business. And let's see, if you make payments to the owners, that was called dividends. And we had revenue when we earn money, sales, and we minused out the cost of running the business expenses. Okay, so if you add up all the assets, that should equal the liabilities plus the capital minus the dividends plus revenue minus expenses. So whenever we had a transaction, we have changed one or at least two of these accounts up here by adding the amount and maybe subtracting the amount and stay in balance with this equal sign here, or adding one item here and then another item here and staying in balance. And we would take the total of the whole columns or the columns accounts to get a balance. The balance is the leftover, and the balances should equal each other. Whatever is on the left side equals what's on the right side, keeping in mind you're subtracting out the dividends and you're subtracting out the expenses here on the right side of the equal sign. So this tabular format is maybe one way of keeping track of your transactions. You have to change at least two accounts for every single transaction, changing at least two accounts. And the only way we make changes is either to increase, we show a plus, or decrease, showing a minus. But instead of using plus and minus now, we're going to learn debit and credit. So here's an example of how we can illustrate debits and credits. So for each account, instead of having one column like we saw on the table, we're going to form this letter T. And we're going to put the name of the account at the top of the T. And on the left side of the T, we call this the debit side, abbreviated with the letters DR. And on the right side is credits and abbreviated with CR. It doesn't matter what account you're dealing with. Debit is always the left side and credit always on the right side. And depending upon the rules for a certain type of account, debits could increase or debits could decrease. Likewise, depending upon the type, asset, liability, revenue, expense, the type will determine whether credits will increase or decrease. And what you're doing now is putting the dollar amount either on the debit or the credit side to increase this account. And you're going to add up all the debits and add up all the credits and take the difference between the two to get a remaining balance. And if you have more debits than credits, that remaining balance is going to be a debit balance. If you have more credits than debits, then the remaining balance is going to be a credit balance. So what we're learning is called the double entry system, meaning that you're going to have at least two or more accounts changing. Again, changing means either you're increasing or decreasing. But now the way we show increases or decreases is with the use of debits and credits, the left or the right side of those T's. Now the total dollar debits you record in any one transaction has to equal the total dollar credits. So just like we saw in the accounting equation back in chapter 1, wherever we had entered a transaction, we have to stay in balance. Now, here we have to record in any one transaction, dollar debits and dollar credits have to equal. If you only record credits in one transaction, right away that transaction is recorded incorrectly. The total dollar debits and the total dollar credits have to equal. You have to change at least 2 or more accounts in any one transaction. So here's an example of amounts being recorded in a T account. Again, they don't give us the name yet, but here I can see a debit to the transaction, the account, and probably some other account at the same time has to record 10,000 of credits. Remember, that's the rule for our double entry accounting. Total dollar debits and total dollar credits in any single transaction has to be the same, and you have to have at least 2 accounts changing. Here is another entry being posted, number 2. So possibly another account is being debited at the same time this is being credited for 3,000. Or let's say here is a third transaction. Maybe this 8,000 is a credit here and a debit over here. At least 2 accounts have to change, and total dollar debits and total dollar credits for that one transaction have to equal. Let's move on here. You can see if you add up the total debits, that's 18,000. If you add up the total credits, that's 3,000. Now what you gotta do is take the difference between the two totals to get a balance. A balance means left over. And the balance is probably going to be the same way you increase the account. So I can see you have more debits here, increasing. Here you're decreasing. So this is a positive 15,000. 18,000 minus 3 is positive 15,000. And in this case, it's a debit balance. Positive, the same way you increase it. Sometimes we call this the normal balance, the same way you increase. Here's a second example. Here's a couple credits being recorded. That will be a total of 11,000. Here's one debit being recorded, and you would take the difference. When you combine debits and credits, you never add. You always take the difference. Here you can see credit, credit. You would add. If you had another debit here, you would add the 2 debits. Then you would take the difference between the 2 subtotals. And here you can see we end up with a balance left over of a positive, the same way you increase, $1,000. Again, this side would probably be the decreases. The normal balance of an account, be it debit or credit, is the same way you would increase. Okay, so now what's the rule to increase or decrease? How do I know whether the debit or the credit is the increase or the decrease side for this account? Well, it all depends upon the type of account. And here's 2 types. Asset is one type, remember, things we own. And whenever you want to record an increase to an asset account, you would put the dollar amount on the debit side. Now, a lot of people think debit means decrease and credit means increase. Well, that's true for liability types. Debits will decrease and credits will increase. So you got to know this rule for increasing and decreasing. In the case of assets, debits increase. And the opposite of an asset we own would be a liability we owe. So it has the opposite rule to increase, here with a credit. Okay, so you got to know this rule now. Now, the reason why a lot of people think that debits mean decreasing, maybe the bank says, oh, we're going to debit your account. Well, what the bank is talking about is not your account. They're talking about their own account. To you, to them, you are a liability because they owe you money. And here, they're going to reduce, so here, debit your account, reduce the amount they owe you. So when you come to your own money, your bank account, when they debit your account on their records, you're going to credit the amount of cash in your bank account, reducing it. Okay, so don't get confused with debit and credits the way you've learned it as a layperson. We're learning the real accounting rules here. Depending upon the type, here assets, debits increase and credits decrease. And just the opposite when you deal with your own liabilities. Increasing with credits and decreasing with debits. Now for the other types of accounts, here we just saw asset and liabilities. The rule for expenses is the same as the rule for assets. Think of this as costs. Costs is increased with debits. The same thing is true with the dividend account. That's not listed here. Increase with debits, reduce with credits. Liabilities use the same rule as revenue. Here, instead of stockholders' equity, we can say, let's say the common stock account. All of these are increased with credits and decreased with debits. So you gotta know this rule, otherwise you won't be able to journalize, or what we call record transactions. So here is a summary of the rules for most of the accounts. If you want to work with an asset and it's increasing, you gotta record the dollar amount of that asset as a debit. And you know, at the same time, because of the double entry accounting rules, some other account has to be credited when you record a debit. Assets and liabilities have the opposite rule. Here's things we own, and the opposite of an asset is things we owe. Here is the way we make money, and here's the cost we use up to make that money. Has the opposite rule. Revenue and expenses have the opposite rule. This equity is probably, again, the common stock account. Let's look at one more detailed illustration here. So here's our old accounting equation again. Assets equal liabilities plus equity. And here is the T account for the assets, showing you increasing with debits. That's the first debit credit rule we learned, and decreasing with credits. Liabilities on the other side has the opposite rule, opposite side of the equal sign, opposite rule. Now they break down their stockholders' equity into more detail. Common stock, which is added on this right side of the equal sign, retained earnings added, revenue added, all have the same increasing rule with credits. This revenue credit. But if you're decreasing dividend expense, the rule to increase an expense and dividend is to increase with the debit side. Okay, maybe let me rewrite this equation all over again. So the rule again is assets are equal to liabilities plus, what was it now? Common stock, retained earnings. Common stock plus retained earnings minus dividend plus revenue minus expenses. So let me rewrite the equation. Remember, this is just basic arithmetic. Let me take these two negative items here and throw it on the left side of this equal sign. So assets plus the dividend plus the expenses are equal to the liabilities plus common stock plus retained earnings plus the revenue. Now everything's positive. There's no minuses here. Now what do these three types of accounts have in common? Here, let me show one big T account for all this. Debit is still left and credit is still right. These three types are increased with debits and reduced with credits. And on the opposite side of the equal sign, we have this 1, 2, 3, 4 types of accounts. Let's go back here. 4 types of accounts. Debit is still left, credit is still right, but now these 4 types are increased with credits and decreased with debits. The opposite of an asset is a liability, and they have the opposite type of debit credit rules. Here's money going out to the shareholders, and here's money coming in from the shareholders' common stock, and they have the opposite rules. We earn revenue. This is what we want to do, right? And we try to minimize expenses, and they have the opposite rules of debit and credit. So maybe before you do your homework, before you take a quiz, definitely before you do an exam, you should try rewrite out the debit credit formula, the debit credit rules. How do you increase or decrease an account with a debit or credit? This is probably one of the hardest things to practice, to learn. So you got to do it over and over and refer to your notes to get it accurate. So what we're going to do now is be given transactions. So here's what we call a source document. You're reading this transaction, reading this invoice, reading the source document. In our textbook, most transactions are just given to us in 1 or 2 sentences. But in real life, what you would do is see lots of paperwork, and you gotta be reading it. Now, as the accountant or the bookkeeper or the clerk, you gotta record the transaction. Here in Chapter 2, the recording of the transaction is called journalize, and you're putting it in a record called a journal. You're analyzing the source document. Now you're journalizing the transaction, and eventually you're going to group the transactions into a more accurate or updated type of summary called a ledger. When you record the transaction here in the journal, that's called journalizing. When you transfer the amount from the journal to this summary called a ledger, we call this posting. And then eventually we'll see something called a trial balance after finishing this ledger. The journal, another name, is sometimes called a book of original entry, maybe because this is the first place you'll see the debits and the credits being recorded. So all the transactions is recorded in chronological order. So this journal is almost like a diary of your business. Everything happening to the business is recorded in the order it happens. First thing first, last thing last. And it's going to help you now. Well, it makes it easier if everything is summarized in a book like this, and you don't have to go back to the actual paperwork, all this millions of pieces of paper your business has been accumulating over the year. So here's an example of a journal. There could be various types of journals in a business, but the main one is called the general journal, or we just use the letter J to abbreviate it. Here's an example of a transaction. We have the owners, the stockholders, investing $15,000 cash in exchange for the stock of the business. And then another transaction is to have the company buy equipment and paying out cash. So both of these transactions happened on September 1st. So in your journal, you would write in the date and write in the first transaction, the account name. The 2 accounts, remember, have to change in one transaction, and typically the account being debited, the dollar amount goes here, is written first, and the account being credited dollars is written second in the next line. We would skip a line, maybe write an explanation and then skip a line, and then record the next transaction in the order they happen. So here's the account being debited, cash, for this money coming in. Tell me, is the cash increasing or decreasing? Of course, cash is an asset. This asset is increasing, and we use debits to increase assets. So you know the next thing we're recording down here has to be a credit of $15,000 going to common stock. And I know the rule for common stock, that equity account is to increase with a credit. Then the second transaction is to record equipment asset, just like cash, being increased with a debit. Now the credit here of $7,000, what do you think it's going to be? Well, you're spending cash. Cash is an asset, and this asset is going down if you're spending it. So you got to credit that account. You probably would write the number 1 because it's also September 1st. You don't have to write September again because it's already up here. And the format we typically do is write an explanation, maybe making reference to a deposit slip for this money going into the bank account. Or here writing in C receipt or invoice when we bought the equipment. Okay, so this is a general journal, and here's one entry and another entry being recorded, being journalized. Here's another transaction on July 1st. Our company, Butler this time, buys a delivery truck. The cost of that delivery truck is a total of $14,000. We're making a down payment of $8,000 cash right now, but the rest of $6,000 we're going to borrow. We're buying it on account for that balance of $6,000. So this is one transaction, and you got to record all the accounts being changed. So that would be the delivery truck, this asset, cash. So now this delivery truck is not $8,000 cash we're paying, but it's all $14,000. And you got to remember now, at least two accounts have to change. At least two means could be two or more. In this case, you got to record this $6,000 going someplace, right? And remember now, you owe this $6,000. Owing is a liability. So let's take a look at the entry. The debit entry usually goes first. Here, that delivery truck called equipment account. Asset increased by the full cost and not just the amount of cash we're paying. Here, the full cost of 14. And then the account being credited, cash, but we're not spending 14, we're only spending 8. The double entry accounting rules said the total dollar debits gotta equal total dollar credits. So we need 6,000 more credits over here. Again, what's the account being credited? We owe money, and the account for liability type that's common is called accounts payable, being increased with a credit. Here is cash being credited, being decreased asset credit. Here's another asset, but this time being debited for the full amount. So at least two accounts have to change, and the total dollar debits and the total dollar credits have to equal for any one single transaction. Yeah, this one transaction here. Again, this is being recorded or journalized in our general journal. Another way to picture the next record, called a ledger, is to look at the accounting equation again. Assets are equal to liabilities plus the stockholders' equity. And instead of having those columns like we saw back in chapter 1, that tabular format, yeah, the accounts payable column, the retained earnings, common stock, dividend, revenue, expense columns. What we're going to do, instead of having columns, we set up one page for each account. And on that page, we have the T. Remember the debit and credit side? Here's the supply T, the land. Think of each account as one page. Lots of liabilities now in this example. Here's the retained earnings T account, common stock T account. Now all of these pages put together is going to form a book called the general ledger. Sometimes when a person talks about the company's books, probably they were talking about the ledger or the general ledger of the company, showing all of the accounts, showing all of the changes to accounts, be they debits or credits to the accounts. A summary of those accounts can be put onto one page called a chart, and all we're doing is listing down the name of the account and assigning it an account number. Yeah, the name of the account and account number. More and more, probably almost all accounting is now done on computers, and a fast way to enter data into a computer is to use just numbers, the numeric keypad. Remember, off to the right side of most big keyboards, computer keyboards, is that adding machine type numeric keypad. So you can enter dates with the numeric keypad. You can enter dollar amounts with the numeric keypad. Now, instead of typing out the name of an account, you can enter the account number. All of these are unique numbers for each of these accounts here. And notice that they're not sequential, like there's a gap between this 101 and 112. That's just leaving room in case later on our Pioneer advertising agency needs more accounts in between this two accounts. They can insert another account number and the name. Notice that the accounts here are kind of organized by the sequence here. In the 100 series, those are reserved for asset type accounts. Liability accounts are in the 200 series. Equity accounts are in the 300. Revenue in the 400. And probably for most businesses, the most numerous type of accounts that you want to keep track of in detail are expenses. So you can see expenses can run from 6 through maybe 1,000, although there's lots of gaps in there. So this is called a chart of accounts. Not really a ledger that has dollar amounts, but just the type. Here's the types: asset, liability, revenue, equity, expense, the names of the accounts, and the assigned numbers to those names. Here is a ledger just for cash. So if you think of that page again, the book, the journal ledger, you return to the cash ledger page, and here is the T, the left and the right side. And because cash is an asset, this is the increases to the cash account, and here's the decreases. What you do is take the numbers from the journal, remember the book of original entry, and once you have a full page in the journal, or maybe a month's worth of transactions recorded, now you transfer them, the word is called post, into the ledger. And here we see that one page of the ledger, the cash ledger. We rewrite the date from the journal, and a debit in the journal is posted or recorded here as a debit in the ledger. A zero balance we start off with, 0 plus 25,000 gives us a running balance here in this last column. In the T's we saw before, we didn't have this third column, but now we have enough room in the ledger to add another running balance. Here's a credit being posted on this date. A credit is subtracted from this debit balance to get a smaller debit balance. A debit here with another debit, increasing the balance. Okay, so at the end of the month we have this amount of cash in our company. Or let's say from June 9 to the 17th we had this amount of cash. So you always can tell how much of an account you have at any point in time if the ledger is updated currently. Okay, so you just look at the balances of that date. Let's go through a little bit more detailed example. So we have a transaction here in the journal. We record it, we journalize this transaction, debiting cash and crediting common stock. And once you have a page worth of transactions in your journal, or a month's worth, then you transfer, or you call it post it, to the ledger. So we look at the date of this debit to cash. We go to the cash ledger, we write the date. A debit in the journal is going to stay as a debit here in the ledger. We don't have any previous balance, so we just carry it over to the balance column. To show where this debit comes from, we go back to the journal and look at the page number. J stands for General Journal, page 1. And to indicate that this 15,000 in the journal has been posted, completed, we take the account number for cash. Remember how we saw that in the chart of accounts? And we rewrite it here in this reference column. Whenever you see a reference number here, that means this number has already been posted into the ledger. So you don't double post it again to show you have too much cash, right? Also, if you see this empty, that means that number hasn't yet been posted or updated into the ledger. Here's the common stock being credited, so you turn to the common stock ledger page in the journal ledger. You rewrite the same date. A credit in the journal is going to be posted as a credit in the ledger. Here coming from page 1 of the journal. You update the balance. You take the account number and now you write it in this reference column in the journal, to indicate that this credit now has been posted into the ledger, so you don't have to post it or double post it by mistake, right? Again, if it's empty here, that means these amounts still have to be posted, updated into the ledger. Let's review the analysis here in terms of debits and credits. So the way you should be thinking for any transaction is the simple thing is, what's the date? Remember, you record transactions in date order. And then for the transaction, you ask yourself, now what accounts are changing? What's the name of the accounts? So if you don't remember what the name of the accounts are, the best thing to do is to look at your general ledger or look at the chart of accounts, and all of the accounts for the business should be there. The next thing to do is to determine what type of account are they. And there's only a few types, right? Remember, we talk about assets, liabilities, equity, stockholders' equity or common stock, dividends, revenue, and expenses. Okay. What type of account here is changing? Then the next thing to do is whether the account is increasing or decreasing, or plus or minus, like we learned back in chapter 1. Now, maybe the hard part is, how do you increase or decrease that type? Do you do it with a debit or credit that we're learning here in chapter 2? And of course, the easiest thing about recording any transaction is just the dollar amount is pretty much just given to us. Okay, the date, account name being changed, the type of account. Is it asset, liability, equity, expense? Is it increasing or decreasing? Now you got to figure out, are you going to debit or credit the account? Maybe again, the easy thing to do to determine how to increase or decrease with debits or credits is that assets, expenses, and the dividends are increased with debits and decrease with credits. And the other accounts, opposite of an asset is a liability, opposite of revenue, expense is revenue, opposite of dividend is common stock. These three are increased with credits and decrease with debits. Okay, so maybe you lay this out again also to determine how to journalize or record transactions. So here's a transaction we've seen before. The owner investing cash into the business. And here's how we did it back in chapter 1. Recorded under the cash column increase and recorded under common stock column increase. But now here in chapter 2, instead of doing this, we go to the general journal, write in the date, write in the first line the account being debited and the amount of the debit. Next line we indent, write in the account being credited and the amount of the credit. Cash is increasing, cash is an asset, asset increase with debits. Common stock increasing, common stock is a equity account increase with a credit. So now when you have a whole bunch of transactions here in the journal, really not just one, then you would transfer or post it into the general ledger. So you turn to the cash ledger page, rewrite the date, rewrite the amount in the correct column. Again, the debit in the journal is posted as a debit in the ledger. A credit in the journal is posted as a credit in the ledger. Very easy to put it on the wrong side, and we'll see how maybe you can catch that mistake later on. Here's another transaction. The company is now buying equipment. The amount is $5,000, but we're not paying for it right away. We're borrowing it by signing a promissory note, here called note payable account. So here's how we would record it back in chapter 1. But again, now from now on, chapter 2 forward, we're going to be journalizing like we have in the general journal. The date, account being debited, equipment asset increase debit. Here, account being credited, notes payable, and that's the key here. The word payable indicates liability, and we owe more, so the liability is being increased with a credit according to our debit credit rules. And if you were to post it, here debit and credit to the proper ledger accounts. Next transaction. We're getting $1,200 cash in advance from a customer, a client, that we're expecting to complete their work in a couple months. Okay, so cash increasing, being journalized debit, and the credit. You notice this new account here with the word revenue. It's not really a revenue account. Whenever you see the word unearned in the name of an account, or the word payable like we saw in the previous transaction, those are indicating the accounts are liability type, indicating we owe something. In this case, we owe $1,200 worth of services to our client because we haven't finished the work. It's going to be finished in a few months from now. In the meantime, we owe something. So here is a liability account being increased, we learned, with a credit. And you can see the posting down here. Another transaction. Here we're paying. Whenever you see the word pay, right away I know cash credit, cash going down, right? Cash going down. And the debit, in this case, is the rent expense. Rent expenses increasing with debits. So here is the ledger accounts after the whole month's worth of transactions. Okay, so you're first journalizing everything, now you're posting it here in the debit credit columns of the proper ledger accounts. You're keeping track of a running balance after every posting. Looks like most of the others have only one item, so you not really have to do that much math here. So now at the end of the month, you'll take the last balance. Last balance here, I'm circling, or it's already in red. But this is a debit balance. Assets, asset, asset, asset. Here's a liability. These assets have debit balances. More debits than credits. This liability is a credit balance. See the credit here, no debit? Payable, liability, credit balance. Remember, unearned is a liability, credit. Common stock is a credit. Dividend, debit balance. Revenue, credit balance. Expenses are debit balances. You're going to take these red numbers I highlighted, and the ones with debit balances, you're going to put here in this column of this new report. And the ones with credit balances, you're going to put it in this right-hand column. This report is called a trial balance. It's not the same as a balance sheet like we learned in Chapter 1. The trial balance, the main purpose is to test whether this general ledger is in balance by taking all these red balances and making sure total debit balances are equal to total credit balances. And in this case, it does equal. Now, what type of accounts remember there's only 5 types, are in this debit column? Well, here are assets. Here is dividend. And here are expenses, yeah? All increase with debits. So they have leftover debit balances. These are liabilities. Common stock, equity, right? And revenue type. All increase with credit, so they end up with credit balances. So the test here is to try to make sure you have equal debit balances and credit balances. And probably that indicates you're on the right track, but not necessarily indicating everything is error-free. Here it mentions that there could still be errors in your accounting records. So let's say that you forgot to record a transaction. Well, the ledger, the trial balance is still going to equal. So let's say maybe you forgot to record this transaction. That means the expense, rent expense, and cash is going to be off. Your cash is going to be too big by 900. Your rent expense is going to be too small by 900. And if you look at the trial balance here, this is going to be too big, the cash. And the rent expense is going to be 0, right? But you still end up with the same total. So if you forget to record a transaction, you're still going to balance. Or here, you record the transaction, to journalize it, but you didn't put it into the ledger. You forgot to post it. Or you posted twice. That's going to throw off the two accounts you posted twice to. But you still will balance over here. And a couple accounts listed here will be off. Maybe you posted to the wrong account. You're still going to balance. Maybe that 900, you put it into revenue instead. This is going to be 900 less. Remember, when you combine debits and credits, it'll take the difference. And you still will balance. This will be 0 and this will be 900 less. So you got to be careful when you work in accounting. Now, most things are automated, computerized, but there's still the possibility of making mistakes. Okay, so this is hopefully a video lecture that you can learn from for Chapter 2. And the reason why I'm recording it is because of the long weekend holiday. Otherwise, contact me if you have questions. This is Roy.